Welcome back to Miller Momentum. Today we're going to dive into DBMF and SDMF and look at their structure, their marketing claims, everything about them, and talk about why DBMF is my clear preferred choice. Today, we're doing a deep dive into two managed futures ETFs, DBMF from IM Global Partner and SDMF from Simplify. On the surface, SDMF looks like a passive, index tracking, half-price version of DBMF. But is it really? I want to test all three of those claims against the actual prospectus and primary documents because, as we'll see, none of them hold up the way the marketing implies. Three questions are on the table right now. Is it really passive? Is it a clone of DBMF? And the big one, is SDMF actually cheaper? The spoiler here is the answer to all three of these is not really. So let's get into it. First, let's meet the two funds. On the left, we've got DBMF, the original, launched in 2019, actively managed by Dynamic Beta Investments as a sub-advisor to IM Global Partner with a 0.85% expense ratio, roughly $2 billion in assets as of the end of last year, and a 5-year track record. To clarify, I think they're over $3 billion in assets under management now, and DBMF was administered as a private managed fund going back to at least 2016, I think. So it's got a little bit longer of a track record than 2019. Now on the right side, we've got SDMF, brand new as of February 2026, issued by Simplify, passively tracking an index, allegedly, with a 0.35% stated expense ratio and about $26 million in assets. It's a very new fund. It's not that concerning that it only has $26 million right now, but it doesn't have that great of liquidity yet. And at first glance, SDMF looks like the smarter buy, right? Same idea, half the cost. But I've flagged the 0.35% line for a reason. We're going to come back to that number, and it won't look the same by the end of this video, let me assure you. Now, both products come from the same brain, Dynamic Beta Investments, or DBI for short. DBI built a proprietary model called the Dynamic Beta Engine. What it does is it estimates what the largest trend-following hedge funds, CTAs or commodity trend advisors, are doing by analyzing their recent 60-day returns. Then it builds a portfolio of about 10 liquid futures to mimic their average behavior. That is the engine inside DBMF. That is also the engine inside SDMF. The difference is delivery mechanism, right? So DBMF holds the futures directly, actively managed by DBI. SDMF buys the output of that same model in index form through total return swaps. And here's the tell. When you look at SDMF's actual portfolio holdings, the swap legs are literally coded DBMF. That's not a coincidence. That's the same strategy. It's a little bit of a simplification to say this, but not actually that much. The passive index that SDMF uses is the active DBMF fund. It's using an active fund for its passive index, if that makes sense. So, yeah, a little misleading, but, you know. So let's meet the firms and the people involved here. So, there's three entities that share the economics. DBI is the engine room. Andrew Beer and Matthias Mamumani built the Dynamic Beta engine, partnered with IM Global Partner, and their strategy underpins both products. IM Global Partner is the distributor and advisor for DBMF, and it owns a stake in DBI, so it profits from DBMF's 0.85% fee on $2 billion or really $3 billion now. Simplify Asset Management, founded by Paul Kim and David Burns, is the issuer of SDMF. So critically, DBI does not manage SDMF. Simplify's own team manages it. DBI's only role in SDMF is providing the index model. Here's the conflict to keep in mind. DBI earns from both, the active version and the index version. That's worth knowing when you're deciding which wrapper to buy. So let's take a look at how DBMF works under the hood, because understanding this makes the SDMF comparison much clearer. Step 1. DBI's model observes the trailing 60-day returns of the roughly 20 largest managed futures hedge funds. Step 2. The dynamic beta engine reverse engineers their approximate positioning. It doesn't copy their trades. It figures out what combination of liquid futures would have produced similar returns. Then step 3, it selects roughly 10 futures contracts. Step 4, it allocates long and short positions across equities, interest rates, currencies, and commodities, rebalanced weekly. 3 key numbers to keep in mind here. 0.85% expense ratio with nothing hidden behind it, roughly $2 to $3 billion in assets as of year-end 2025 and at the start of 2026, and over a 90% correlation to the SocGen CTA index since inception, which is what it's trying to base itself on. And critically, DBMF targets the pre-fee CTA returns. It tries to give you the gross performance of the strategy minus only its 0.85% fee. Keep that word pre-fee in mind. Now we're ready to get to our questions. First question, is SDMF really passive? The short answer is, in the legal and regulatory sense, yes. It's registered as a passively managed fund. The prospectus discloses passive investment risk. The advisor won't sell a holding just because it's underperforming. All of that is true. But here's the substantive reality. The index that SDMF tracks is not a neutral, market-determined benchmark. It's a proprietary, weekly refreshed model that DBI built and administers. It analyzes the most recent CTA returns, estimates their positioning, selects the contracts every week. The active intelligence is fully intact. It's just been embedded in the index methodology rather than executed by a portfolio manager. SDMF is best described as systemic active replication delivered through a passive wrapper. Don't mistake it for the kind of passive investing that Vanguard pioneered. This strategy is fundamentally the same as DBMF's. Second question, is SDMF a clone of DBMF? Look at this table. Same model provider, DBI. Same target universe, the largest CTAs. Same 10-ish liquid futures, same 4 asset classes, same weekly rebalance. 5 out of 9 dimensions are identical. The differences are real but secondary. Direct futures versus swap-based delivery, active versus passive governance, different issuers. And to drive the clone question home, SDMF's own holdings files lists its swap legs with the identifier DBMF. That's not marketing spin, that's the fund's own portfolio data. The honest answer is, SDMF is a swap-based, index-wrapped near clone of the same DBI strategy that powers DBMF. It's not an independent competitor, it's the same basic product in a different legal costume. Now here's what changes everything, for me at least. Here's how SDMF looks. 0.35% versus DBMF's 0.85%. That looks like roughly half the cost, right? But here's what the Simplify prospectus actually says. And I'm reading directly from the document, not paraphrasing. The level of the index will be calculated after deducting an index fee of 0.55% per annum, calculated on a daily basis. That 0.55%, if I'm understanding correctly, is deducted from the index before SDMF even tracks it. So the real math is 0.35% stated expense ratio plus 0.55% buried inside the index, which equals approximately 0.90% all-in drag before you even count the swap financing spreads that are embedded in the swap pricing but never show up in the expense ratio. DBMF's 0.85%, that's the whole thing. No index fee layer, no acquired fund fees, nothing hidden. SDMF is not cheaper overall. On a like-for-like basis, it's marginally more expensive. The half-the-cost comparison is, in my opinion, an accounting relocation and not a real savings, but probably is very beneficial for marketing. Let's visualize the math here. Look at the chart on the left. The blue portion is the stated expense ratio. The amber or orange portion is the index fee that's deducted inside the index. For DBMF, it's simple. 0.85%, all blue, nothing hidden. For SDMF, the bar is actually taller once you stack both pieces. 0.35% in blue plus 0.55% in amber equals 0.90% overall. The table on the right breaks it down further. SDMF also adds 0.15% in acquired fund fees from the money market funds it uses as swap collateral, fees that DBMF avoids because it holds treasury bills directly. Then on top of that, there are swap financing spreads that are embedded in the swap pricing. They never appear in the expense ratio, but the investor pays them through reduced returns. Bottom line, in the orange box, SDMF approximately 0.90+% all in. DBMF comes out to approximately 0.85%. What you see is what you get with it. Not the comparison Simplify's marketing implies, in my opinion. Simplify's press release and marketing say that the swap structure may enhance tax efficiency. This is worth examining carefully. DBMF holds futures directly. Regulated futures contracts trade on U.S. exchanges and are generally what the tax code calls Section 1256 contracts, or 1256. I've heard people use, different pronunciations of it. But these get a blended 60% long-term, 40% short-term tax treatment on gains, regardless of how long you held them. That's usually favorable compared to fully ordinary income rates. SDMF gains exposure through total return swaps. Swaps are generally not Section 1256 contracts. Swap income is typically characterized as ordinary income. So, on the dimension that matters most, income character, SDMF's swap approach may, and I say this may, actually be less tax efficient, not more. We'll have to wait and see. Both funds use ETF in-kind creation and redemption mechanics that help limit capital gains distributions. So it's not completely one-sided. But the enhanced tax efficiency claim is at best unproven and arguably backwards. Don't let it tip your decision without getting specific advice from a tax professional. Now, beyond the fee structure, there are 6 structural risks worth naming for SDMF. First, assets under management and liquidation. $26 million is not a lot. It's still a young fund, so it's not that big of a concern, but in my view it is a concern. The prospectus itself warns the fund may be liquidated if it doesn't gather assets. Small ETFs close all the time. Second, counterparty risk. SDMF depends on swap counterparties staying solvent. That adds a layer of credit risk DBMF simply doesn't have. Third, Single vendor dependency. SocGen sponsors the index. Compass calculates it. Any failure there disrupts SDMF's entire strategy. Fourth, affiliated money fund conflict. Simplify can direct SDMF's collateral cash to its own money market ETF and earn fees. It's a disclosed conflict of interest, but a real conflict of interest. So they have been forthright about that, and I want to highlight that. Fifth, no track record. DBMF has 5+ years of live history, including 2022, which was one of the best years ever for managed futures. SDMF has 4 months by comparison. And sixth, non-diversification. Both funds, but SDMF swap concentration adds single point of failure risk. So also worth noting here is SDMF's median bid-ask spread was about 0.24% in May 2026. If you trade it even twice a year, that's a meaningful additional cost on a tiny fund. So today we've asked 3 questions, and I've given 3 answers. First, is SDMF really passive? Technically, yes. Substantively, in the ways that matter, in my opinion, no. The active replication logic lives inside the index for SDMF. The discretion is still there, it's just been relocated from the portfolio manager to the index rulebook. Is it a clone of DBMF? Quite nearly. Same DBI engine, same strategy, different wrapper, and different issuer. Is it actually cheaper? No, SDMF is not actually cheaper than DBMF. When you count the 0.55% index fee, the all-in drag is approximately 0.90% versus DBMF's flat 0.85%. And with SDMF, you also have to account for swap financing costs that aren't in the expense ratio at all. The marketing implies it's passive, novel, and half the price, and in my opinion, none of those hold up under examination. I am open to counter arguments and to being corrected on this point, but to the best of my understanding, that's my answer. For me, here's the bottom line. DBMF and SDMF are the same strategy in 2 costumes. When you count all the costs, the stated expense ratio, the 0.55% index fee buried inside the benchmark, and the swap financing spreads that don't appear anywhere in writing, SDMF is approximately 0.90% or more all in. DBMF is 0.85% all in, with nothing hidden. Then you've got the 5+ years of track record, you've got the $2 to $3 billion in assets, you've got a tight bid-ask spread, etc. The half the cost claim that anchors SDMF's sale pitch, in my opinion, doesn't survive a close reading of the prospectus. Is there a scenario where SDMF makes sense? Maybe. If you specifically want swap-based index delivery and you're comparing it against net of fees CTA returns rather than DBMF's pre-fee target, that's a coherent use case, I guess. But for most investors comparing these two head-to-head on cost overall, SDMF is the illusion of savings and not the reality. The sources for everything I cited today are going to be down below in the description for this video with links. And if you found this useful, please like and subscribe. Leave comments and questions below. It really does help this channel for you to engage. Anyway, drop a comment. DBMF or SDMF? Which would you hold and why? I'll see you in the next video.